Welcome to the Open Oil Financial Model series. Today we're going to take a look at the financial model we produced of the Bulyanhulu gold and copper mine in Tanzania, which has been run by an affiliate of African Barrick Gold called Acacia Resources since, I believe, production started in 2001. And with me here is Alistair Watson, who built this financial model. So, Alistair, we've seen that the company has recently made a declaration about income tax, which is one of the key questions we've been looking at in building the model. We'll get to that in a second, but before we do that, I wonder if you could just flash up for us the financial model and give us a quick tour of it. And just so that everyone's clear, the full version of the model is available on the Open Oil website. But Alistair, if you could just give us a tour around the dashboard.
Sure, Johnny. Just bear with me. I shall switch to hopefully showing the model on my screen. Just let me know when you can see that.
Yeah, we can see it.
So the model comprises one workbook with 1, 2, 3, 4 substantive sheets in the workbook. The principal sheet where you use and drive the model from and see results is the dashboard. That's what you see before you at the moment. Over on the left-hand side of this dashboard are the key parameters for production and costs for the project from 2016 forwards. I'll come back to that in a second. Then the fiscal regime parameters and key economic parameters such as our assumed inflation rate and discount rate. So all the key parameters to drive the model are on the left-hand side of this dashboard. Immediately to the right of those parameters, you see its tabulation of key results. The key table I've just highlighted, and I'll enlarge a little bit, shows the project, a summary of the project economics so the project results before applying the fiscal system, what the government should receive over the life of the project, what the mining company receives. We've modeled some of the finance the company has taken out, and we calculate here the government share, and we'll come back to interpreting those results a little later in the conversation. And then further on the dashboard are some key charts, which we will talk through some of those. The most relevant to our discussion today being this chart I'm just selecting here, which shows a chart of the government's revenues over the entire life of the Bulyanhulu project, using the assumptions that we've built into the model. Other sheets in the model where the actual work goes on, there's a sheet called inputs, which, as the name suggests, is where we've entered production, both historical production and then future expected production. Costs by category likewise, the gold price history, and we're using spot prices, both historic spot prices for gold, and then we've made an assumption about the future gold price. Of course, we can change that future price and see what it would do to the outcomes of the project, and then certain other parameters to do with financing and so forth. Then the calculations sheet, again, as the name suggests, takes those inputs and derives the cash flows of the project over its entire life before applying the fiscal regime. Then it applies the fiscal regime that is in place for this project under the mining agreement that is in place with the government of Tanzania, and then determines the government revenues by category and the mining company's after-tax outcomes from the project. The last substantive sheet is called chart data, which just takes some of those numbers to capture those that then become the charts that you see on the dashboard. So most of the time you can drive and see all the key results simply from the dashboard. You don't necessarily need to get into any of the other sheets. Okay, Johnny?
Brilliant. So just a couple of questions then. Most users then, although they can look under the bonnet, all of those other sheets you've mentioned essentially are the under the bonnet stuff where the mechanics go on. But if I want to know simply how much revenues the government's looking at with a set of assumptions, it's the dashboard where I could just experiment with changing an assumption like the price of gold or future production or whatever, and I would never need to move off the dashboard. Is that correct?
Precisely, that's right. Yeah.
Right.
One point there, just briefly, as I touched on, what we've endeavored to do here is reconstruct the actual history of this project. As you said, it started production in 2001. And so we've reflected actual production, actual cost structures, and the actual gold price for the history of the project. And so the parameters on the dashboard really concern what happens from now on. So the past is the past. The parameters on the dashboard determine what happens in the future.
And where have the data come from?
So both for production and costs, we've gleaned that from financial statements and reports published by Africa Barrick, Gold. That's now Acacia. So it's all publicly reported information, mainly from financial statements. The gold prices we got from the World Gold Council. So we're using independently reported spot gold prices. And the fiscal regime we've built up from various publicized sources from the company itself, so some Tanzanian government reports. The mining agreement, the mining development agreement that actually governs this report is still confidential, but most of the key fiscal parameters have been disclosed publicly in one form or another. So that's how we've put the picture together.
Okay, great. So that is, what the model is and how it's been built. Let's go back to this question of income tax, because there was an interesting statement by Acacia Resources last week or the week before saying that they were bringing forward the date of beginning to pay corporate income tax. Now, we could look into the details of what that statement says a little bit later on, but it raises what has been the key issue in public debate around this project and indeed other mining projects in Tanzania, doesn't it? Which is this question of corporate income tax and the fact that in this case, Bulyanhulu has been producing for 15 years and a sizable quantity of gold without having reached the stage of paying income tax. What does the model tell us about that issue? Because it's a hot issue in Tanzania.
Yes, it's been quite controversial. I'll just switch my screen sharing back on, and switching now to a presentation where we've extracted some of the information from the model. All of these charts are just directly lifted from the dashboard, in fact. So this first sheet, you see on the left-hand side, the production of the project. So as I said, up until 2015, we had the actual annual gold production in 1,000 ounces. And then using a presentation that the company put on its website, they had some information about forward-looking gold production, so we've reflected that. Then we have on the right-hand side historic gold prices in the blue series here. And then at the moment, the base case that we'll show, we're assuming a future gold price of $1,200 US per ounce. And then to that, we're adding 2% inflation per year. So that's where you see this upward sloping red line. That's consistent with the futures market at the moment, but we'll play with that price a little later and see what impact it would have. When we run the production, I've just shown you the gold price and the cost structure that we got from the company's financial statement. We see this picture of the government's revenues over the life of the project. So from the outset, there's a royalty that was initially 3% and is now 4%. Certain import duties, which are a function of the costs and the proportion of those that were imported versus domestically sourced. But we then see that the biggest chunk of revenue is this orange series, which is corporate income tax. But our model does not show that income tax starting until 2019 in this base case, which appears consistent with the press release that you mentioned, which talks about an arrangement where they're going to start paying tax, but they're bringing it forward 3 years. So 2019, 3 years forward means 2016. So why is that the project has not paid any income tax so far? If I go to the next chart, this shows, it's a little more complicated chart. We see the cost structure, so by category of costs by year. The yellow line is the gold revenue, and the red line, which is the important one on this chart, shows the net cash flows of the project when we take the revenues minus the total costs. If we go back to the start of the project, so construction started in 1999 or 2000, I think, and production in 2001. So therefore you had the substantial negative cash flows. But then, and recall we're using publicly sourced information on production and costs here, it shows that the project did not generate any significant positive cash flows, even before thinking about the fiscal regime, for some years. So this red line is hovering around zero. Then there were some positive cash flows followed by some further negative cash flows. And it's only post 2015, in fact, that we see, this is using the company's own projections, the generation of substantial positive cash flows. The first observation is that the project has not generated significant cash flows, and by proxy that means profits, so far in its life. To that we then add the fiscal regime, which has been agreed for the project, which was put in place in the late 90s in Tanzania, when Tanzania was not seen as a particularly attractive investment destination, and in the context where the gold price, international gold price, was low. So they put in place a regime which was designed to create a strong incentive to invest in Tanzania. And of course, history shows that it successfully did that. However, the fiscal regime comprised a royalty, 3%, as I mentioned, and income tax at 30%. But very importantly, the income tax was designed in such a way that the companies were entitled to deduct all of their capital costs as soon as they were spent, and add to those a 15% uplift called additional capital allowance, until such time as they had generated sufficient positive taxable income to completely offset the initial capital plus this allowance.
Right. Could I just jump in with a couple of questions there?
Sure.
So, I mean, in layman's terms, then you're saying, even though it's been producing gold for 15 years and it's produced something like 3 million ounces, it hasn't generated significant, positive cash flows out of which a tax could come. So my first question then is was that expected from the beginning? Was that part of the original business plan, or has it resulted because of lower prices or higher costs than were originally anticipated? That's the first question. And then the second question is, this mechanism you're talking about, the additional capital allowance, I mean, it sounds quite complex, but if I'm going to invest, let's say, $1 billion, but I'm allowed to account for not only that $1 billion, but another 15% on top, it begins to look a bit like an unsecured loan. In other words, it's not so much investment, but I don't have full security, but I'm loaning money to the project and will be repaid with interest. Is that?
Let's deal with the first question first.
Sure.
You know, I don't believe that the company entered into that investment expecting not to generate profits. What we've seen is since production started, as you could see from the chart I put up, and as everyone I think is well aware, the gold price increased very significantly in the middle of the last decade. However, so on the face of it, one would expect that should increase the profitability. But what happened was that the costs of running the project increased at the same or a greater rate. Don't necessarily want to speculate as to why that may have been. I think that there have been some operational issues that the project's had, but we do see this increase in costs as a global trend amongst all gold mines and indeed most other mining projects. So commodity prices have increased and of course subsequently then decreased, but the costs increased commensurate with that, and so profitability of the project has not gone up as much as one would expect just by looking at the gold price. As to whether the Acacia or Barrick has efficiently run this operation and so forth, that's beyond my remit to comment on, and others can do that. As to the fiscal regime, I wouldn't characterize it in this terms of this unsecured loan. That I think the right way to characterize it from a fiscal regime design point of view is that the income tax was designed only to apply once the company had achieved a 15% return on its investment in effect. So the income tax was only switched on at that point. That's what the 15% additional capital allowance achieved in effect. But what it's done in this instance has generated significant accumulated losses that have taken a long time for profits to offset, and that's why the project has not paid income tax thus far.
Okay, so the model says it predicts that income tax would be liable from about 2019, and as you pointed out, the company statement virtually confirms that estimate by saying it's bringing it forward 3 years from the expected date, this company announcement a couple of weeks ago. How sensitive is future payment of income tax to our estimate of $1,200 an ounce for the price of gold?
Yeah. Well, let's have a look at that using the model. I'll just switch back to sharing my screen. The model. So we can see here in the. I hope you can see the dashboard. The input parameter for the future gold price is here, the $1,200 per ounce, and we can see over here this chart showing that income tax will start. I think at 2018. I think in this current version, if I'm not mistaken. No, 2019, as we said it earlier. If I decrease the gold price to $1,100 per ounce, then of course what that does is push back the date at which the income tax would start to be paid. But still, it still starts in well, it pushes it back 1 year to 2020. Yeah?
Mm-hmm.
If the gold price were higher, $1,300 per ounce, it would bring it forward 1 year to 2018. So, a reasonably significant change in the gold price is moving the timing of that by a year or so, but not drastically altering it. Bear in mind, as I said before, we're only changing the forward-looking gold price here. We're not changing history. Yeah?
Sure. So that's the timing, and it looks as though the price only has a year's impact either way. But of course, what we could also see in that chart as you swapped in those figures is that the chunk, you know, the amount of tax that would accrue to the government varied significantly with the price as well. So I'm wondering then what the forecast is for the overall revenues to the government over the life cycle of the project, say at 1200 and 1300 and 1100 and so on.
Sure. Well, let's look then at this the key table of results, in which we see for the government, with this set of assumptions, I've set the model back to $1,200 per ounce, that over the entire life of the project, in nominal terms, undiscounted, we see the government would receive $4.4 billion of revenue. And we see the composition of that revenue here. 900 million of royalty, 160 million of import duties, 2.7 billion of income tax, and 580 million of dividend withholding tax. Those are the principal direct fiscal mechanisms that we've captured in this model. We do not, for example, include tax on employees' wages and
This is direct fiscal. It's not. It doesn't have any broader measures of indirect contribution to the economy and so on.
So what happens if this changes? So we see firstly, and I've put a little analysis down below, that with this total of 4.4 billion over the entire life of the project, but that's out to 2050 or so. Out of that, only 4% of that revenue has been $164 million thus far, and 4.2 billion still to come. And the biggest single source is this income tax. So we see that things go well, then the government's revenue from this project is about to take a very substantial upward step. But as you said, Johnny, that how big the upward step is very much a function of the gold price. So 4.3 or $4.4 billion for the government. If we change that future gold price to $1,100, so we lower it by $100 per ounce, 4.4 becomes 3.7, and a significant amount of that reduction would be through the form of lower income tax. So the future revenues the government will get from this project is very sensitive to the assumed gold price. Of course, it's also very much a function of assumed future production and future costs, which we could also change in this.
Okay, I think that gives us a good overview. What then of the company announcement? What were the details of that?
Well, our interpretation is, from a news article, is that the government has reached an arrangement with Acacia, where Acacia will start to pay $20 million per year income tax, but it's specifically denoted as a prepayment of tax, and it also says that this is bringing forward tax by 3 years. Hence, as you said before, we believe this announcement appears consistent with our finding that income tax would start around 2019. So they're not increasing the amount of tax they're going to pay, they're just prepaying some future tax. And secondly, they also say that $20 million, our reading is it's not as physical, Acacia are not writing a check to the government for $20 million. What they're doing is offsetting that 20 million against VAT refunds, which the government already owes Acacia. So no additional money is going to change hands under this arrangement. It's simply bringing forward future tax and using that to immediately offset a debt, if you like, that the government owes the company for VAT refunds. So but of course it's still significant that the company is acknowledging that it's appropriate for them to pay and to be seen to be paying income tax. Just briefly on this VAT refunds, this is a very normal part of the design of a value-added tax system is that mining companies, in fact any producer, should not bear the cost of the VAT, it should be the consumer. So mining companies often end up in essentially a permanent refund position because they're exporting their product. So it's a normal part of business that a company like Acacia would be expecting significant refunds. So they're paying VAT, but then it gets refunded by the government. The trouble is, and Tanzania is by no means alone in this, that the refunds are often delayed very significantly. Governments find it quite challenging to repay or to pay these refunds. This is quite a common problem in many African and other countries. So it's not unusual that there is this refund owed to the company, and it's also not unusual that these refunds are delayed.
Mm-hmm.
That's part of the context for this arrangement.
Okay, let's wrap up. Listening to you review the results shown by the model, it seems as though the model basically addresses the key issue of public concern and governance around this project, which is why hasn't it yielded any income tax to date? In fact, it's the numbers from, and let's refresh our memory, from the essentially company's documents to investors, show that from those costs under these contractual arrangements with what started as a 3% royalty, 4% royalty, and then these terms for reimbursement of all costs with this additional capital allowance, put all of that together against historic production and historic prices, and the model shows why income tax wouldn't have been paid to date, and then predicts a date sometime soon in the lifetime of the project that it would begin to do so. Is that a fair summing up and is there anything else you'd like to add?
Yeah, I think it is. I think this is a good demonstration of how such a model, an open source model using only publicly available information, can, if you like, cut through or help to cut through some of the rhetoric that you might see on either sides of these kinds of debates, and provide a factual basis to ask the question: how much tax should this project pay, and when should it pay it, and why has it not paid it to date? So I think we hope it's a useful tool to stakeholders in Tanzania who are interested in this question. And one other interesting aspect, this methodology could also, of course, be applied to the other mines that Acacia and the other big gold producers are running in Tanzania, to look into this same question for all of those different projects. We also see, if we look at the investor outcomes, that this project, even with the future profits that we see projected, it's still not a particularly lucrative project over its entire life for Acacia and Barrick. So the idea of that somehow the companies are making windfall profits and not paying the tax on those is somewhat that picture is different by this analysis. Of course, there is also the question of whether has the company been using fancy tax planning or transfer pricing mechanisms to overstate costs in Tanzania and so on. That's gets into the details, but in order for that to be the case, remember we're using the same costs that Acacia are disclosing to its own shareholders. If those costs were somehow being overstated, for that to be worthwhile, the profit thus being shifted out of Tanzania must be getting to those shareholders somehow, and we can't see how that could have been happening, because it's very clear what profit has been reported in the London Stock Exchange and so on. So anyway, there are a number of lines of inquiry that you could use this kind of model to do, but I think we hope it helps to bring some objectivity and some factual basis for engaging in a good discussion between governments, investors, and other stakeholders who are interested in ensuring that Tanzania and any other country gets the maximum benefit from their natural resources.
Okay, let's leave it there. Thanks very much, Alistair.
Thanks.
And just to remind everyone that the model is downloadable from the Open Oil website. Thank you.